Hi there, this is Alvin from Dr. Wealth. Are REITs in trouble? Because in the recent weeks, I've seen quite a number of bad news that have impacting the REITs. But the good news is that not all REITs are in trouble, but some or a handful of them are actually in trouble. And I want to share with you my views on them. And hopefully you can make a more informed decision if you happen to have some of these REITs in your portfolio. So the very first REIT that we are going to talk about is the Manulife REIT. So it should be one of the REITs that have been appearing in news report, in the media because of the ongoing problems that it has been encountering. So we can see the share price have done very badly, right? Down 74% since the start of the year. And this Manulife US REIT is actually investing a portfolio of Grade A office in the US. So there are prestigious buildings, right? But why are the share prices underperforming? So there are a few key issues that we need to know. First of all, US commercial REITs or the office have a lack of demand after COVID-19 has impacted the world, and people are not going back to the office, right? So people demand less of the office space, and it seems like it is ongoing. It might even be permanent from now on. So that's why there is a readjustment, there is an oversupply of office, and that caused the valuation as well as the earnings of these office REITs to go down as well. And things don't look good for Manulife REIT is because looking at their recent announcement, so for example, they have halted the distribution of dividends because they have certain covenants from the lenders and they have broke that leverage amount, and now they can't distribute the dividends. So they'll use the proceeds to repay the loans to a more manageable amount. So for investors buying REITs, one of the key things people want is dividends, and holding the dividend is definitely one of the worst nightmares that a REIT investor is going to face. So I believe quite a number of unit holders might have just thrown in the towel and just move on from here by selling the REIT. And not only that, the problem is not easy to solve, right? So let me just blow this up. This is taken from the announcement made by Manulife REIT. So they were talking about what are some of the measures that they can do to help the REIT regain itself. So one of the things that they have considered is to sell this Phipps Tower and then use the proceeds to pay down the loan. But however, this time round, they did say that the aggregate leverage will not fall below 50% even after selling this tower and using everything to repay the debts. So what other measures can Manulife REIT come up with to help save the REIT? This is still an unknown, right? There are still discussion going on, the plans are still going on, but the clock is ticking and the share price have been going down consistently as well. And I think this is a major problem. It is not easy to get away with and to recover in the near future. So definitely I'm not optimistic about the prospect of Manulife REIT. And of course, people will start to worry what about other US office REITs that listed on SGX as well, right? So another one is Prime US REIT, and likewise, look at share price is down 65% from year to date. And but the good thing is that for Prime US REIT, it doesn't have a leverage problem, okay? Because for Manulife REIT, the aggregate leverage was above 50%. In this case, for Prime US REIT at 42.8% is rather safe at the moment, right? And that's also on the account that they have not done a valuation. So the key issue for Manulife REIT was that they did a revaluation of their properties, and because the valuation dropped by more than 10% on average for its properties, and hence the gearing ratio shot up. So for Prime US REIT, they did not do a mid-year valuation, and we do not know what's the impact, right? We will only know probably at the end of the year. So if the valuation comes down by a significant amount, this gearing ratio can also shoot up. Okay, so they are not out of the woods, all right? And this is their distribution, right? They did cut their dividend by 30%. Okay, so this means that there is a telltale sign that rental has come down, and usually when rental comes down, the valuation will follow suit because the majority of value of these properties derive from the rental income that it can generate. So if the income is down, likely the valuation has to come down as well. So be prepared that the gearing ratio for this Prime US REIT will also shoot up at the end of the year. And the next one that is related to US office REIT will be Capital Pacific Oak US REIT. It has also been underperforming. Share price has been down 49% since the start of the year. Looking at the gearing ratio, they are the lowest among the three, right? At 38.4%, there's still a lot more space or debt headroom, But similar to Prime US REIT, they have not done a revaluation. Okay? And if we can see their distribution per unit, it has dropped about 17%. Okay? Less than Prime US REIT, so the impact should not be as big. But we can also see that there is a drop, right? Nonetheless, and that also means that the valuation will come down. But I believe that given that bigger debt room for this core REIT, they should be in a relatively safer position as compared to Prime in the coming revaluation exercise. And it's not just a US problem, right? We also know that there is a China property crisis that's ongoing, and some of these China REITs that are listed in Singapore have also shown some cracks. Okay, the first one is Daxin Retail Trust, and you can see the share price have also gone down to be on a penny stocks, less than 10 cents, and share price have declined 72% from the start of the year. So what's happening with this Daxin? Basically, it has defaulted. Okay, so which means it is unable to pay the loans, interest, and the banks have issued notice of demand. So this at this kind of stage, right, is almost gone case. Okay, in my view, right, it's very difficult to salvage. No other financial institution is going to lend you money, and if you can't generate enough property income, how are you going to repay all these loans, all these debts? So this is a huge risk, and even SGX Repco has issued a warning, right, or a caution to investors in trading this Daxin Retail REIT Trust. So this is something that I think investors must really take heed. So the next REIT that is in China is the EC World REIT, and the share price have gone down about 38% since the start of the year, and it has been and currently it's on trading halt because they just made an announcement, right? And the announcement was a pretty bad one. So I believe that once the trading halt has been lifted, the share price might tank. Okay, so what is this announcement? There are a couple of sections that I want you to pay attention to. So the very first one is that the sponsor of this EC World REIT is also the tenant of EC World REIT. So this sponsor come tenant has not paid their rent to EC World REIT, and that's exceeded more than 3 months, and there is no sign that the tenant will repay this eventually. So the manager of EC World REIT assessed that there's a high risk that they will not receive this money. And this will lead to the EC World REIT ability to repay the interest and the loan. Like Daxin Retail Trust, they may run into a default eventually. And the third thing is that the sponsor originally intend to buy over some of the properties from the REIT, but now that is put into question, right? Because they can't even pay rent. How are they going to cough up money to go and buy over some of these properties from the REIT? So now EC World REIT is stuck because they couldn't sell the properties and repay the loan, and they can't get the tenants to pay the rental to in turn pay the banks. So this is where a potential default may also happen for EC World REIT. So I worry that once the trading halt has been lifted, the share price might take a big hit. And I also picked up another news about Lease Global REIT. It was published on Business Times, and one Citigroup analyst was downgrading the Lease REIT from buy to neutral, and the target price also lowered from 78 cents to 61 cents. And he also said that this is likely due to the high gearing of Lease REIT, and expect some rights issue to happen down the road. But to me, Lease Global REIT at about 40% gearing, it's not a very high number, right? 40% is pretty normal. And in fact, in March this year, it was at 39.3%, and after that, it raised a little bit to 40.6%. I think this is reasonable. It's not something like what we have seen so far with regards to the huge jump for Manulife REIT, right? So the valuation of the properties, in fact, went up. So it was more of the borrowing that went up, but not by a significant amount. So to me, I think Lease REIT in this case should not have a big issue, right? And there are quite a number of REITs that have more than 40% gearing, and they are mostly in the commercial space, because likely due to the types of property they have, the value tends to be a lot higher, and it's likely that you will gear up a little bit more. So I think 40% is rather kind of a normal number, and I disagree with the analyst that 40% is a high gearing. And nonetheless, the share price have also came down by about 18% since the start of the year, and there is a big drop in the past 1 month, as you can see in the chart itself. But I don't think that it is a REIT that is in trouble, right? It's just that the sentiment is a little bit bad at this moment. And another piece of news is a blue chip REIT, which is Capital Land Escort Trust. They did a preferential offering as well as a private placement. Usually when a blue chip REIT does a preferential offering, right, it's usually oversubscribed, okay? And in this case, it is not. It is only 37% subscribed. So it's very underwhelming. It doesn't look good on Escort REIT at all. So what's going on, right? So I really think that it's just poor timing, okay? Why is that so? When they did the issue of the preferential offering, it actually was really at a discount to the market price. But then after that, the share price fell, not because of this preferential offering, but more of the macro factors. Because in the US, in the past 1 month, the long-term interest rate has gone up. And this long-term interest rate, when they go up, is going to impact REITs, because REITs are going to hold debts over many years. And these debts are refinanced when they are due. So they expect this REIT to have this interest rate impact for a longer period of time, right? So that will reduce the distribution for a longer period of time too. So that is why most of REITs have fallen in the past 1 month, is because of these long-term rates. It's not just a specific REIT issue. So Escort REIT somehow did this preferential offering at the wrong time, and that caused the share price of Escort REIT to go below the offering. So in a case like this, why would the investor pay for the rights when they can get it cheaper from the market? So I think this is where the problem comes in, and the undersubscription happened. But come to think of it, maybe, you know, given that the sentiment is still pretty bearish with REITs, right, it might not be a good time to raise money from investors. Should just wait for a better time, right? When it's more bullish, when investor appetite has expanded, there's a better period to raise money, basically. So this is summary, right? So we have seen quite a number of REITs that are in trouble. I hope that you are not in them. But if you are, you do need to pay a lot more attention, right? For me, I always like to avoid problems. I won't definitely be looking at buying them and then, you know, trying to sell for a quick 10-20% profit, because if the REITs are already in this downward spiral situation, it's very difficult to get out of it. I happen to have those problematic REITs, and if I do have them, I would actually consider just selling them, moving on. But that's just me, okay? At the end of the day, you make your own decision. I just hope that this video will give you more information to think about what is the best course of action to take for yourself. So the issue is a combination of a high interest rate environment. I thought about the long-term interest rate going up in the US, and eventually Singapore inherited that, and hence it impacted all REITs. Okay, it is not just specific REITs. All REITs will suffer because all REITs borrow money to a certain extent. And the second thing is China property crisis does affect some of the China REITs that are listed here, right? We saw that even sponsor for EC World REIT is in trouble, couldn't really repay the rent. And we also see weaker US office demands due to the shift. The work from home culture has not really gone away even after a few years since COVID has happened. And all this have led us to see some REITs have started to break down, and yet there are still REITs that are holding up quite well. So this is actually the best time, right, for us to really differentiate what are the stronger REITs and what are the ones that we should go with. I don't think one should avoid REITs altogether. I do think that there are good REITs, and you can check out some of the videos that I've done before, right? What constitutes a good REIT. Okay, so I hope you like this video. Give me a thumbs up, subscribe to the channel so that you'll not miss another video like this. Thank you for watching, and I'll see you in the next one.